Business mergers and acquisitions, or M&A, can really accelerate growth, expand market share, and, increase profitability. However, these transactions also come with complex tax implications that can significantly impact the value of a deal. Understanding the tax considerations before finalizing a merger or acquisition is essential to minimizing liabilities and ensuring long-term success. One of the most critical tax decisions in an M&A deal is how the transaction is structured. Asset purchase. In an asset purchase, the buyer acquires selected assets and assumes certain liabilities. Sellers may face double taxation if structured as a C corporation. Buyers benefit from increased depreciation and amortization through a stepped-up tax basis. Stock purchase. In a stock purchase, ownership shares are transferred directly. Sellers often benefit from capital gains tax treatment. Buyers inherit all existing liabilities, both known and unknown. The chosen structure affects both parties differently and should be carefully negotiated. The tax treatment of sale proceeds depends on asset classification. Capital assets such as goodwill typically qualify for long-term capital gains rates. Inventory, receivables, and depreciation recapture are generally taxed as ordinary income. Improper allocation of the purchase price can result in higher taxes than expected. The IRS requires that the purchase price be allocated among different asset categories using Form 8594. Allocation impacts sellers' taxable income, buyers' depreciation, and amortization deductions. Negotiating this allocation early helps prevent disputes and ensures both parties achieve favorable tax outcomes. So, companies may carry forward net operating losses to offset future taxable income. However, in mergers and acquisitions, Section 382 limits the use of NOLs following an ownership change. These limitations can, significantly reduce the value of a transaction, if not properly evaluated. M&A transactions often trigger multi-state tax consequences. Income may need to be apportioned across multiple jurisdictions. State-level transfer taxes or sales taxes may apply. Also, nexus rules may change after the transaction. Failure to analyze state tax exposure can lead to compliance issues post-transaction. Tax due diligence is honestly critical. Buyers should review past tax returns, payroll tax compliance, sales and use tax filings, and any unresolved audits or tax disputes. Uncovered liabilities can reduce deal value or create long-term financial risk. After closing, businesses should reconsider entity structure, accounting methods, depreciation strategies, and transfer pricing policies. Good post-merger planning really maximizes tax efficiency and operational integration. Taxes play a central role in the success of any merger or acquisition. A well-structured deal can increase value, while poor planning may lead to unexpected tax costs. At SK Tax Associates, we help businesses navigate M&A tax planning, due diligence, and compliance to protect your investment and support seamless transitions. Contact SK Tax Associates today to ensure your merger or acquisition is structured for maximum tax efficiency.